Should I do a loan modification on my house or should I pursue a short sale? It's a question that every troubled homeowner will have to decide. And for some people, it's much easier to figure out the answer than for others. I'm going to go through some of the key considerations that you need to make as you're trying to arrive at a decision. I'm going to give you a small disclaimer. I hate disclaimers. It seems like a way for someone to cop out of giving the real information, but for this particular challenge, it needs to be said. Your situation is not the same as anybody else's in the world. There are a lot of people facing hardship on their homes, and there are people with similar challenges, and I'm going to address most of the major points that you should consider. But please understand that if you're really wanting to make a good, informed, and educated choice of where you need to go and what direction you should take, you really need to give me a call and have a completely free, 100% confidential discussion about these points. And we can work through your specific challenges and scenarios and situations and find the best answers for you. So let's start by talking about a loan modification and when you should or should not consider that as opposed to a short sale, and when you should or should not consider a short sale. We're just going to assume right off the bat that you have a legitimate hardship. I'm not going to address, making sure that the bank is going to accept your hardship. That would be the topic for another video. In fact, I have another video that you can check out that talks about that. One of the primary things that you need to understand is that your bank will treat a loan modification or a short sale just almost the same as they handled the original loan application. They're going to want to see tax returns. They're going to want to see bank statements. They're going to want to see pay stubs, or if you're self-employed, a year-to-date profit and loss. They want to determine if you have a financial hardship. And on top of that, they want to determine if they were to do a loan modification, could you afford the resulting payment? Now, another thing that the bank is going to want to see is a hardship letter, and that will help them if your hardship is a non-financial reason, so medical or job relocation, military deployment, hard family situations like divorce. That can be contained in the hardship letter, but they're trying to figure out if they should work with you. And then if they do, on the loan modification side, if you have the finances to afford the payment that would result. Let's talk about payments for just a minute. On average, when a client comes to me and we have a conversation and they have achieved a loan modification, typically the difference in the payment is somewhere between about $70 less than their original payment up to about $70 more than their original payment. The difference, why your payment could go up when you're doing a loan modification, is if they're rolling in a lot of back payments and penalties and interest and attorney's fees and things like that. If you've been in default on your loan for a year or 2 years and you go in to do a loan modification, there's a pretty good chance that your end payment will be higher than your existing payment. I have seen people get better loan modifications. I've seen a few people get several $100s. In the last 5 or 6 or 7 years, I've seen one person actually get a loan modification of over $1,000. It was a very specific situation, a very small bank that actually couldn't afford to do a short sale and didn't want to do the foreclosure. So usually your payment will either go down, a range of something about $70 to $100 less, or possibly about $70 higher than your current payment. In determining if you should do a loan modification or a short sale, if you want to stay in your home and you think that you would be staying there for at least the next 3 to 5 years, we should be looking at the possibilities of a loan modification. If you don't want to stay in the house, if there's been property damage, mold or something that's causing health issues, or if you'd like to take a new job but it's too far away, over 50 miles away, or if you have a possibility of a job relocation down the road, if you think that you will be selling or have a possibility of selling in the next 3 to 5 years, but you're upside down in your value, maybe you owe $300,000 and the house is worth $220,000, you should probably be looking on the short sale side, even if you're not necessarily ready to make that long move right now. We'll talk about that in just a little bit. Let's go back to the loan modification. You want to stay in your home. You think you'll be staying there for a while. You need to make a very detailed and complete household budget. Groceries, utilities, credit payments, everything. Put everything down on the list, insurance, and figure out what you can afford as a house payment. And then the next number you need to figure out is the most that you could possibly pay on a house payment without borrowing money from family or credit cards or savings or retirement. You don't want to have your house sucking money out of you or other people. And so what's the most that you could afford as a modified payment in your household budget? Then when you go to your bank, you can say, I'd like to do a loan modification. My payment has to be X, whatever that is. And it will help you when the bank comes back and says, okay, we've got your payment down to $1,000. You can look at your budget and say, yep, that works, or nope, I needed it down to $700, or whatever those numbers may be. If your bank cannot offer you a loan modification for lower than what that payment needs to be, or if they decline you on a loan modification, you need to look at doing a short sale. That's should be a very key consideration. Banks typically are following the HAFA program, HAFA. You've probably heard of that. Home Affordable Foreclosure Alternatives. The guidelines in that program state that the bank should try to get your payment somewhere between 31 to 38% of your gross monthly household income. And so you can look at that, and if that doesn't seem like it's going to be low enough for what your needs are, you probably should be considering a short sale. Now, back to the short sale side. If you're thinking about moving, if job transfers, all of those reasons I discussed, and you're upside down, as hard of a decision as it is right now, you probably should be seriously considering a short sale. A lot of people look at it this way. You know, if I maybe my family's going to grow, have parents moving back in or kids moving back in, or we just had twins and don't have enough bedrooms or whatever, but we're in a position where at some point in the future we know we're going to need to move in the midterm, 3 to 5 years. It may be better to do the short sale now because you'll be faced with the same dilemma 3 years from now. You owe more on your home than what it's worth. And really, a lot of people consider that it's better to go ahead and get that sold now, start rebuilding your credit, and 3 years from now when you decide that you need to move or when that job transfer comes through, your credit is rebuilt and you can go out and buy a new home. Hopefully interest rates will be low and value should be relatively close. They may be a little higher, maybe a little lower. But now you're back on your feet and you own your own home, as opposed to waiting, struggling to make the payment. And now 3 years from now you get that job offer and you have to move, but you have to short sell then. And so you're renting for the next 3 years. So some people consider that it's better to start that now. From a credit standpoint, is also a reason to do a loan mod or a short sale. In today's marketplace, if you have had a notice of default filed on a home, you can get another loan for another primary residence 2 years after that notice of default is cured. And that would be with 20% down, or 3 years after the notice of default is cured without needing extra down payment. Now, a lot of people don't catch that key word of cured. They think, okay, I had a notice of default filed at such and such a date. It's 3 years later. I can now buy a house and get an FHA loan or have a low down payment. The date that this criteria runs off of is when that notice of default is essentially removed. So either you've been foreclosed on, or you've completed a loan modification, or you've short sold the house and it has closed. That's when the 3 years starts. And so you want to resolve the situation either through a loan mod or a short sale as quickly as you can. We don't want a foreclosure on the credit for sure. That has all kinds of problems, and I'll do a video that talks about the different factors or damage that occurs from a short sale versus a foreclosure. I hope that this information has been helpful. Like I said, there's a lot to consider. These are some of the key points when you're trying to decide between a loan modification or a short sale. Again, please feel free to call me anytime. I'm very available. We can set up a time to talk and discuss your specific situation as you're trying to make this important decision.